How's it going, everybody? Welcome back to another podcast episode of Smart Money Moves with your host, myself, Samir Sawaka, Director of Client Engagement here at Freedom Family Office, and Kyle Cain, our wonderful CIO. As you guys know, if you're just tuning in and you're wondering what the heck is this podcast is really aimed at providing you market insights in such a rapid way that regardless of how busy you are as an entrepreneur or business owner, you can come in and digest within 5, 10, or 15 minutes the market insights that Kyle is going through all week, sharing with clients, sharing with his network, etc. So this week we're going to talk a little bit about the Fed, and this will be a sort of shorter episode, if you will. But again, it's something you can digest in 5 to 10 minutes. So Kyle, we last spoke to you about a couple of weeks ago. We saw that the Fed actually did cut rates. I think Powell made a lot of comments, and I saw the market go up and down in that last hour as he was making comments. For someone that has no idea what he said, other than the obvious that he cut rate, how do you digest the meeting? What does that mean for interest rates in the future? Are you bullish? Give us your rundown.
Yeah, appreciate that. So yeah, like you said, now it's Friday, September 19th. Fed just met 2 days ago, Wednesday. They cut interest rates by 25 basis points, right? And if you kind of remember, did a rate cutting cycle exactly a year ago. They started it and they cut about 100 basis points. And then they've been on pause the entire year. With all the tariff disruptions, they've been on pause until we finally got the first rate cut. Uh, ultimately, let's first talk about how interesting this particular meeting is, right? We're in a pretty, say, new dynamic. We had some new individuals that were in the Fed meeting to vote on it. It's Steve Moran, right? Which is a little bit strange considering, he's a legit economist, so nothing against him. But he does work directly for the Trump administration, right? He's taking a leave from his job as the chair to come in and be a Fed governor until he can be replaced. So we had him in there voting. And then we also had Lisa Cook, who obviously, the president specifically tried to get fired, but it was ruled that she could vote. So I'm sure that, that 2-day meeting was a very interesting one. And we saw that sort of in the dot plots, right? So when the Fed meets, they do, they vote on what they should do with monetary policy. And then a few times a year, they put projections on where they see policy going forward, right? So in this one, just to give you a little bit of where we're at right now, they cut 25 basis points. And the dot plot show that, expecting 2 more cuts this year at their October and December meeting was sort of the median. However, they only showed one for 2026 and one for 2027. So technically that would bring it down to 3.25%, the Fed funds rate, from where now it's at 4 to 4.25, which is less than what the markets were sort of pricing in of it going below 3% in 2026. So I'll touch back on that here in a minute. But then, so even a little more interesting is when you look at the huge divergence, was a little bit more than normal. Everyone did vote for a 25 basis point, except for Stephen Moran, who voted for a 50 basis point cut. But then when you look at the dot plot for the remainder of the year, these are anonymous, so you don't really know who's doing what. But one individual actually said that there's going to be a rate hike from here back up to 4.5 before the end of the year. And someone said that there's going to be another 125 basis points of cuts going below 3% by the end of the year. So that's a pretty significant difference on what they're showing there. So it just shows that, things have become a little politicized. However, likely, again, there's 19 members. And we see that the median is still being based on fact, right? So I guess the question is, why did they cut? Ultimately, inflation's still above their target of 2%. But job growth has slowed significantly, right? We just had the report that came out that said 911,000 jobs were revised down over the prior 12 months ending in March. So instead of 146,000 jobs a month last year, only about 70,000 were created. And then over the past 3 months, there's only been about 29,000. So we've seen job growth has slowed, So, Powell basically worded it, said this is sort of a risk, reduction cut. And he was asked specifically, is this supposed to help the employment situation, a 25 basis point cut? And he was honest and said, no, this isn't going to do anything. However, it's the path. So he did confirm that, they are on a rate cutting path. The markets didn't know how to digest it initially, as you're pointing to. It kind of dropped a little bit as he was talking, or when the report came out, because a lot of this was priced in. Like I said, the markets were already pricing in rates to go down significantly. And the interesting thing is, right, if you compare what their projections are, they report on, what they think the interest rate is going to be, but they also report on where they think inflation is going to be, GDP, and employment. And so compared to the last time they did it was back in June, they indicated some more rate cuts than they did back in June. But you'd think it was because they were concerned about the economy and slowing in the jobs, which is what Powell said. They actually increased their GDP expectations for this year, next year, and 2027. They also lowered their unemployment, meaning they think that the job market is actually better than what they thought back in June, even after all of these revisions, going into next year and the following year. And they increased what they think inflation is going to do. So the data, that's where I think the markets were a little bit confused at first, as it was contradictory, them thinking that the economy is going to be strong and inflation is going to be higher and employment's not going to be that bad. Why are they cutting based on job data? So I guess to kind of cut through the noise, right? Ultimately, the markets are reacting positively from it. And the thesis is that anytime the Fed has been able to cut rates and avoid a recession, the stock market is up. Every single time that's happened so far in the past. And I think it goes to the point of, yes, the job market is slowing, but it is so much from just the demographics of an older population, and the big thing being an immigration slowing down. So the break even is slower. And I think the biggest silver lining that we can see from the revisions and job cuts over the past year is that even though 911,000 less jobs were created, the economy still, it was like 2.8% real GDP last year, which is above average growth, meaning that productivity is a lot higher than we expected. And we're going to need that in this environment because I don't think immigration is going to turn around, anytime soon. And certainly unless a whole bunch of retirees decide to come back into the workforce, I think we're going to continue that. So we need that productivity growth. And I think that the job market, with how much money, with the tax bill that's coming, with lower interest rates, I think unemployment isn't going to rise that much. And that's what the markets are starting to think, is that, all right, things are a little bit shaky. There are some risks, but started going into next year when some more of these tax bills, deregulation, and lower interest rates start to impact, we should start to see not huge job growth, but we should see that it remains stable. At the same time, inflation will probably be higher, but again, they're looking through that as being more transitory with the tariffs. So, I'd say that's kind of a perspective on, what happened with the Fed, what it means for sort of the economy. I won't go too much into that, but it's, there's pros and cons to rate cuts. Everyone thinks of the pros of, all right, things are cheaper, and the stock market really likes that. But what I'm trying to say is rate cuts probably help the stock market more than it does the economy.
Right.
To be quite frankly, right? Like it actually, if you really looked at the numbers, it hurts income, right? It hurts people who are just have cash sitting on the sidelines that they're just earning, plenty of interest off of. So that interest income is going to go down as interest rates fall, more so than individual liabilities. Like there's more cash sitting there that they're earning interest off of and off their bonds and things like that could go lower than there is floating rate liabilities out there. Most liabilities are mortgages that are locked in, so lower interest rates don't really help them. Obviously, there's plenty of positives, right? It could help start to finally, if we get mortgage rates down, it can help spark the housing activity. Lower rates can help small businesses, quite a bit and let them be able to, to hire. So again, at the end of the day, right, there's going to be some significant implications. Um, but I guess I could talk about that a little more, where the markets are going to, potentially go from here. But I think just wanted to wrap that little bit up with saying that, overall markets are taking it positively, and we should be on a time to at least become less restrictive with interest rates.
One question before we close out is, you mentioned markets and how interest rates benefit markets predominantly more than, I'd say, other factors. I guess one quick question: as interest rates go down, how does that help real estate investors? Either people, does it make it more of a buyer's market or a seller's market? Doesn't it impact with mortgage rates? Anything there?
So yeah, so that has a so I'll say two things. One, it certainly can help activity, right? And the thought is, first and foremost, builders. All right, we know that we have just still a supply shortage of homes out there, but it's not it's not much incentive for builders to borrow at these high rates. Uh, that hurt their cost in a potentially slowing economy, which is what we've been seeing. So they've been sort of hurt. If we can now all of a sudden help the consumer with tax cuts, which we're getting with deregulation, um, and then we can get lower rates, it helps the affordability, and they may have some more incentive to produce. So it could help builders. At the same exact time, though, of course, a lot of the lack of supply is one, just overall lack of supply, but also there isn't any activity. People aren't selling because they're locked in at these lower rates. So again, I don't want to go this. We go down a huge rabbit hole talking about this. Lower rates may actually flood the market more with supply, which is which is still a good thing overall, because people now feel like they can move. Because now they might be giving out their 4%, mortgage to buy a 5% mortgage, versus which I'm more comfortable with, versus giving up their 4% mortgage for a 6.5. So it will spur activity, and in the housing market, even though directly it's only about 4% of GDP, it's got this big, you know, um, cyclical kind of expansionary mode to it, right? Then when someone moves, that might be the housing market's 4%, but then they buy furniture, then they switch things up, and they help the economy with an expansionary, um, exponential growth from there. So that could spur specifically growth in the housing market and help the economy on that front. I would say the other main investment implication sort of takeaway from this is, what is it going to do for the markets? What should I leave in, our listeners sort of thinking? And this is an obviously investment advice, feel free to reach out to us if you want to review your situation specifically. But right, yes, the combination of, we should be able to avoid a recession in a rate cutting cycle. Markets are always up. We have the tax bill, which is helping sort of businesses this year. Next year should help the U.S. consumer next year, when they get some bigger tax refunds. It should help to continue the expansion. Again, risks, of course, are the concentration of the stock market, right? Top 10 companies make up 40% of the S&P 500, and valuations are high. So point being is that it should be able to continue. I wouldn't be too worried about valuations right now, but enough to recommend diversification, right? Diversify into different assets. The dollar, if we're in a rate cutting cycle, usually the dollar continues to depreciate a little bit, which could help international. I'm still U.S. focused, but it could help international as a place to diversify, considering their PE earnings are about, actually their PE ratio is about 40% less than the U.S. So it's a lot cheaper there.
Right.
But I like more growth stocks do better in our falling interest rate environment. Um, the biggest, I like, again, just kind of the cyclical areas. Financials should do well
Right.
in this type of environment. Tech, software, play the AI trade still. But as I said on previous calls, diversify a little bit further away from, just the NVIDIAs, kind of spread it out a little bit further. I guess the only risk I potentially have here is, which, to keep in mind, I'm not completely concerned with it. I don't think it's going to be an issue. But the last time the Fed did the rate cutting cycle about a year ago, what happened initially, as soon as they did the rate cutting, interest rates rose. Not on the short end. Short end fell, but the long end rose because the impact, the overall thought that growth is going to stay up and inflation's going to come back. And then we're already at a fiscal, you know, sort of an unsustainable path with fiscal deficits. So bottom vigilante came out and the 10-year went up to 5%. Leading up into this rate cut, 10-year treasuries fell from about 4.5 down to about, hit about 4%. And then now since the rate cut, they've came back up again.
Right.
We're up, from about 4 up to about 4.15 or so. So again, still a far cry from that 5% where, the markets certainly don't like 5% on the 10-year. But we could see more of that. That's the main risk, is if all of a sudden the focus came on that, all of the, the benefits that we talked about with housing, the mortgage rates going down, can't do that if the 10-year goes up. And the growth stocks and the cyclical stocks, the small cap stocks, which would benefit from lower rates. And we've seen that, small cap Russell 2000 just hit an all-time high for the first time since 2021. So something to keep an eye out for out there, which of course we are for our clients' portfolios. But overall, I think it should be a positive, and the markets continue higher into next year.
Yeah. Thanks, Kyle. That was really well said. We appreciate you tuning in to this week's episode of Smart Money, Smarter Moves. Now, if you guys are interested in talking about your specific situation, feel free to go to freedomfamilyoffice.com or email Sameer, Sameer, at freedomfamilyoffice.com. You can also email Kyle directly at freedomfamilyoffice.com. All the links are in our description, and we will see you guys next week for another episode so you can tackle the markets a smarter way. Thanks, everyone.